Hi guys. So one of the students in the mentorship group asked me about how to draw supply and demand zones. Now remember, when you're doing your analysis, first things first, you switch to a line chart, right? Now, why a line chart? Now the line chart is going to give you the closing and the opening prices of your candles that are formed on the swing high and on the swing low, right? And in most cases, those candles, whether it's to the upside, it becomes your bearish order block. If it's to the downside, it becomes your bullish order block. Now the line chart is going to help you to eliminate the wick, the price action of the wick. In most cases, that's market manipulation. And when you're doing your analysis, always make sure that you are using the price action of the body of the candle to determine your levels. So now I've got a pound New Zealand dollar here. I did a top-down analysis on it, I think 2-3 weeks ago. So I'm just going to do another top-down analysis highlighting the supply and demand zones and how you highlight your proximal and your distal lines. This is basically for me to illustrate to the student how to go on about highlighting the zones. Now, so first things first, I'm gonna switch to a line chart. Now before I do that, okay, I'm just gonna switch. Remember, it's very important, it's crucial that when you're doing your analysis, you start from a higher time frame, from monthly, weekly to daily, right? And then you define your entry points on H4 and H1. Now the H4 and the H1 time frames, the zones that you have defined on daily, weekly and monthly, your entry time frame needs to be inside those zones, right? Now I'm going to show you here, right? I've got a pound New Zealand dollar. So what I'm emphasizing is, don't start on daily and then you highlight your supply zone or your demand zone on a daily time frame, then you go to a weekly time frame. No, you start from a higher time frame going to a weekly time frame, then you go to a daily time frame. Now this is a line chart representing pound New Zealand dollar, right? So clearly we can see we've got a swing high here, we've got a swing low, market moves to the downside, then we have a short-term lower high, right? Then market created a new low, then it created another lower high on its way to this area here. Now when you're looking at price action, the 9 to 18th month period is crucial. How do you determine that, right? The 9 to 18th month, we start from here, period 11 bars, so our 18 months is coming right at this higher low. We're the lower low, then we're the higher low here. This is probably where our 18-month candle is. Remember, you need to look at your market profile from a period of 9 months to 18 months. But if there's levels that you need to consider that are outside of that range, you must highlight them, but only on a monthly and weekly chart. So I'm gonna highlight my swing high here, right? Now this line is coming in at the swing high is coming in at 2.08110, right? That's the swing high. Now we have a what? A new low that was created. Market moves from this high to this low. We had a new low, then market moved again, created a higher low, see, and then we had market move again to the downside, created a new low, right? You can see all this is inside my 18-month period. I'm gonna mark also this short-term higher low that was created. So this is a lower high, this is a short-term higher low, because we had a new lower low. The reason why I'm not going to consider this, because it's outside of my 9 to 18 month period. But when I look at price action, say for instance price is now somewhere here, I will have to consider that level. So now I also have to mark this short term higher low, and then we have another one right here. Now this low here, this higher low, I'm not gonna mark it, but I know exactly that's, let me just mark it for interest's sake so that you see. Can you see this is where we found, remember, it was support, broken to the downside, market comes back, it becomes resistance, market comes back, it becomes resistance. So now I just need to make sure my lines are all at the same date. So I'm just gonna put, say, month of 7, let's say 10, right, 10 June, 10 July, right, for instance. So this is basically just making sure the lines are all at the same. So we have 10, so this is July, let's put 30 July 00, right, 30 July, let's put 30. So this is 2021. I'm sure you can see the reason why I'm doing this, so that these lines are all at the same levels. So 2021 07 30, same applies. Now it's very important that you do this. The reason why it's important is because you're going to be using these levels probably for the next 4 to 5 months. You see, it's very important because this is a monthly chart. We're going to go on a weekly chart once we are now on the candle stick. This is 2021. Same applies here. We also put what? 07 30, and then same applies here. 07 30, so this is 2021, right? So now my levels are all in line. Now I'm gonna switch to a candlestick. You don't need to do the line chart on the weekly and on the daily time frame. You only do the line chart on the monthly. Now remember, the levels that you mark on the monthly, they're going to have an effect on the weekly chart. They're going to have an effect on the daily chart. Now I've switched to my line chart, and instantly once you have done that, you can see already this is my last up close candle before price dropped, right? You see, now this is again my last up close candle before massive displacement, right? You get the point? Now we also have, this is my last down close candle before market impulsively move to the upside. Now from the monthly chart, you only need to highlight the body of the candle as your zone. Now you can clearly see this line. It's right at the closing price of the last up close candle. You can see this line. It's right at the closing price of the last up close candle. That becomes your distal line for the zone. Now you have a distal and you have the proximal line. Proximal line is the one closest to price action, right? To current price. So for instance, right now we've got this candle here, right? Now for you to be able to validate the level as a supply or as a demand, you need to see the following candle's body close way below the opening price of the last up close candle, right? You need to see this following candle closing below the opening price of the last up close. That becomes your supply. For your demand, you need to see the next bullish candle close above the last down close candle for it to become your demand. Like for instance, in this case, we've got this candle here. Yes, I didn't mark it, but for illustration purpose, I've highlighted the body of the candle and expanded my area of focus to the right. Now I also need this rectangle to be on 30 July. You see, now the opening of this down close candle becomes your proximal line, right? Now that's the opening. Now I'm going to extend this to 30. This is 2021. Now this becomes your proximal line. You get my point? I hope you understand perfectly, Raul. This becomes your proximal line. Why does it becomes your? Because that's the price, the line that is closer to price action. Distal is the line furthest away from current price action. Now I'm gonna just copy this, then I put it on the closing line. Now that becomes my distal line. These lines, they're going to be useful when you're defining your entry prices. So this is the distal. Now in this instance, this is our supply zone. We already have our distal line here, right? This is our distal line. Then I'm gonna copy this line, put it on the opening price, because this candle impulsively moves to the downside and close below the opening of the last up close candle. Now this line becomes my proximal line. You see, that's how easy it is to highlight your zones. Once you get to the institutional supply and demand, this dot here will represent your 50% mean threshold of the zone, right? This down close candle becomes your bullish order block. This last up close candle becomes your bearish order block. You see, 50% mean threshold, that's your optimum area to take your shorts. 50% mean threshold, that's your optimum area to take long positions. Now coming back to current price action, you see we've got this candle here, the last up close candle before the market dropped and closed below, right? So this becomes your this would have been your supply zone, right? This is your supply zone. So you had your proximal line below, you've got your distal line below. Now look at current month. It's way above the level. It has broken the level, right? Meaning, as long as price is still above there, it's not ideal for you to be shorting because the level has been broken to the upside. The market structure has been violated. But you can see when price came in, right? Let me put the 50% mean threshold of this bearish order block, which was validated as a supply zone here by this candle. See, every time price came to the 50% mean threshold, it found what? Resistance, and it dropped. Came back to the 50% mean threshold, found what? Resistance. Following month, it dropped. In May, price, the high of May comes right at the 50% mean threshold, and price dropped. Now, this drop on its own is a total of 227 pips. Now, the current month, can you see we have broken to the upside, meaning now it's not ideal, it's not a conducive environment for you to be hunting for short trades, right? Because price has broken to the upside. There's evidence supporting further moves to the upside. There's a strong bullish momentum now. You need price to close below this candle's closing price for you to be able to start hunting for short trades. Now, this is a monthly chart, remember. Now I'm gonna go on to the weekly chart with my levels defined. Now, can you see I only marked 3 zones, right? Yes, this is a down close candle, but this candle does not close above. This one does not close above, right? This one is a down close candle, but this one hasn't closed yet, so it hasn't validated this level yet. But you're going to see when we go to the weekly chart, right? On the weekly chart now, can you see this candle, right? That's where price is trading to. Now remember, this is now our monthly zone, the gray shaded area. That's our monthly zone. Monthly supply, monthly demand. This supply this week, if it closes above, then it becomes violated. You're no longer taking what? Shorts, because this area is now violated. You're looking into this price action, this candle here. You see, this is our last up close candle, right? Now I'm gonna highlight, yes, the body might be a bit small, but that's like 20, that's almost 30 pips. That body is what? Range. Right. So this is my weekly level. I'm just gonna put a different color so that we can see the difference, so that you understand as we go to lower time frames. So the magenta color, that's my weekly supply zone. Now we also have where's the levels? Now this is supply. We also have this candle here. Can you see this candle here? That is a supply zone. This candle is a supply zone, but already it's on a monthly level, right? It's on a monthly level. So these two different shaded rectangles, they are weekly levels, right? You can see now the structure. Price is moving to the upside. Lows are being respected. Highs are being violated. Buy stops are being cleared and market continues. Sell stops are being respected. Market is offering only buy side liquidity, meaning we are in an uptrend, right? For shorts to be valid, it has to be inside this weekly level, right? At the 50% mean threshold of this weekly chart, or when price comes to this level here. Now you've got your proximal line here and your distal line. You see the closing of the up candle, the open of the up candle Opening is your distal line, closing is your proximal line. The opposite applies for down candles, right? But we don't have any clearly defined demand zones on this weekly chart, right? Now, you don't need to move your levels to adjust your levels when you go to the lower time frame. I've got my monthly levels there. I've got my weekly levels marked. Now I'm going to go on to a daily chart, right? Now this is a daily chart. You can clearly see we've closed above our monthly zone. Now that's a what? A resistance that has been broken to the upside. What happens when a resistance is broken to the upside? When price comes back, it becomes support. You see, a resistance level, a supply zone that has been violated to the upside. When price comes back, it's now a demand zone. A demand zone that has been violated to the downside. When price comes back, it becomes supply zone. So you can clearly see there was a long trade today here. Price yesterday closed above, today traded into the supply that was broken to the upside yesterday, and price moved to the upside 111 pips. But now this is only clearly visible when you go to your entry time frame, which is H4. Now you see this, I still have my monthly zone highlighted, the gray shaded area. That's my supply zone on the monthly chart. Look how price was respecting the 50% mean threshold. Now this is on your entry time frames, right? Your H4. Here we had a consolidation. You see, market building orders, buy stops taken out, price comes back to your mean threshold, and boom, it takes off, close above. The moment it closed above here, shorts were no longer valid on pound New Zealand dollar, because we have now cleared the buy side liquidity. That now paves way for price to move to the upside. Now where's the target? When price has broken this level, your target is up here, the proximal line of this weekly supply zone. Now this is my H4 time frame. As soon as this candle, let me zoom in, right? As soon as this candle closed above, right, I would have already known that, okay, this old distal line is now my support, my new support level, my new demand zone. You can go further onto a lower time frame, right? This is the H4, 1, 2, 3, 4 candles that broke and close above. You see, price comes back to a supply zone that has been broken to the upside. You'd have been a long trader here, right? 35 pips. Now see, every time price comes to the old supply zone that was broken here, every time price comes there, it's pushing to the upside. It's finding support and pushes to the upside. So today it has already offered like a total of 110 pips, which is not bad for a day, right? So this is today, you see. Yesterday there was price action, it closed above. So today you would have been hunting for long trades, not shorts, right? Not shorts. You've been hunting for long trades. From which level? From the supply level that was violated to the upside. When price comes back, it's now support. You see, you're going long. The further you go on to lower time frames, you see, the levels becomes even much clearer. You see, I hope you understood perfectly. So in your questions, you asked me, should I adjust my supply zones on H4 or weekly, or stick to D1? I believe if I move to H1, then we'll move again. No, you don't need to adjust your zones that you have highlighted, right? But remember, you start highlighting your zones from monthly, then you go to weekly, then you go to daily, right? When I switch to H4 or W1, then the supply zone needs adjustments. No, you don't need to adjust, because that's the level you're going to trade from. You see, like today, pound NZD, Asian market open 2 a.m. price traded into the old supply zone that was broken here yesterday. Price found support, rallied 103 pips. Again, it came back 11 a.m. mid-session of London session. Price came back, found support, rallied again 104 pips. Day trading concept. Those are two setups already that would have yielded 200 pips. You don't need to adjust your zones, right? Let's assume I'm looking to trade this is intraday or swing. On which time frame should I be marking my zones? Right, if you're looking for intraday, that's day trading, right? The zones that you're going to use should be based on daily time frame, right? Intraday trading, you must base your zones on the daily time frame. But if price comes into a weekly zone or a monthly zone when you're on the daily time frame, yes, you can also intra trade. And for swing trading, I would advise you use levels on the weekly chart, right? Let's say price on H4 is now into your weekly supply zone or your weekly demand zone. Yes, you can swing trade that position. Now let me see what other questions you had. Now I've noticed your drawings, right? You started from daily, which was not ideal. You start from the monthly chart. You start from the monthly chart to highlight your zones, right? So this is my monthly chart. This is where I started. Now can you see this level here? This level, let me just highlight it for you. This candle here, it would have offered trading opportunity here, trading opportunity there, trading opportunity here, trading opportunity here, trading opportunity there. You see? Now this is when you go on to lower time frame, right? You're not gonna wait for that monthly chart to reach the level. You're going to drop to lower time frame. This is where you're going to be taking your trades from. Now this is a daily time frame. If you notice clearly, right, this is my monthly zone. I didn't adjust it, I just went to the lower time frame. On this day, you see, like on this day here, this is when you'd have been in the market for short trades. You see, price is in your monthly zone. You look to swing trade that position when you enter, say at H4, right? So this is the same price action, right? This is H4 entry, right? Price, it means on this day when price was in this range, you are looking for short trades and you're looking for a swing position. Where is your stop in all this? Above your distal line. You see? Above your distal line. So a swing position from the 50% mean threshold, remember, that's your ideal entry point. Yes, you can open a trade as soon as price reaches your proximal line, but now your risk is going to be a lot. An entry point from the proximal line here, you would have had a risk of almost 200 pips, and that's too big. But an entry from the 50% mean threshold of your zone, right? Remember, this is our bearish order block, this is our supply zone. Your risk would have only been 100 pips for a return of close to 400 pips. That's a 1:4 return. If you had missed that opportunity, price came back again here on H4 and it dropped 172 pips. Now here, this would have been a losing trade. But if you were scalping on lower time frame, 20-30 pips, but it would have been a losing trade after how many times? This would have been a trade 150 pips. This would have been a trade all the way 560 pips. So after a lot of times getting opportunities to short from this supply zone, this monthly supply zone, only once you would have lost. You see? Only once you'd have lost that trade, because that is the breakout. That's the break in market structure, which is inevitable. Eventually you lose money, but the point is minimize your losses by following the rules. So the mistake that you did was starting on the daily, because it means you have disregarded the levels on the weekly, you have disregarded the levels on the monthly. So yeah, I hope I've answered your questions. Let me see on Telegram if there's another question, because I think you had another question. Just a minute. Let me open my Telegram. Yeah, I think I've answered your question, because you asked also I need to understand how to plot the proximal line for supply zone and demand zone. Is it the candle that takes out the close of the distal or the low of the distal? No. Your supply zone is your last up candle, right? The open and the closing of that candle. The open is your distal, the closing is your proximal. But it can only be valid when you see the following candle impulsively move to the downside and close below the opening price. Now for a demand, it's the last down close candle, the candle that has got the lowest close before the move to the upside. The open of that candle becomes your proximal line, the closing of that candle becomes your distal line. So this candle, you need to see it massively move to the upside and close above. Yeah, I hope I've answered some of your questions, but as always, send me your questions and I'll attend to them. I wish you good luck, man. Thank you.